you were a bond investor, you were gloating for 2008, 2009, even though you didn't do as well in stocks in 2010, you did well. And why? Because interest rates were coming down. That's what this chart shows. And so your bond prices were going up. We think that game is about over. And if you're a bond investor, you can watch that $1,000 gain you had in my example of bond going from 1,000 to 2,000. If interest rates come from 2% to 5%, you will have blown all of that gain and some more in that 10-year note. So this game we think is ending. And basically what we would do in here is we favor corporate bonds because you get a little more income from those. A lot of people are very scared of the municipal market, which is sold off dramatically in December and January. We would actually think it's much more hyperbole than it is reality. Junk bonds still, and then we favor something called floating rate notes. These are really, they were very common 5 or 6 years ago. They do very well when interest rates are rising because these notes adjust their interest rate as interest rates go up or down. And they adjust every 30, 60, or 90 days. So that interest rates move, and 30 days from now you own the note and they go higher, your note's going to pay you a higher interest rate. And you can buy these, they're out there in mutual fund form, they're out there in a variety of portfolio fashions that you can get access to. They tend to do well when the economies are improving, check the box. They tend to do well when the risk for raising interest rates is present, check the box. So that's why for some portion of your portfolio, it might be an interesting protective device. Outside the United States, in the common equity markets and fixed income markets, we like commodities. Now they're very pricey right now. Commodities have gone sky high, as you all know. Gold, silver, copper, textiles have gone high, grains have gone sky high. Cotton is at an all-time high since the Civil War. Cotton price, 50% of the world's cotton, and we're the major exporter. 50% of our exports for cotton are consumed by what country? China. So they're not growing the cotton, but they're buying ours. So check your shirts. Because this cotton may very well have been from the United States, but it may have very, very well been milled in China. Okay? So we like commodities because what's happening in the emerging markets is they're going through rural economies to urban economies. And when they do that, they got to have more metal, more minerals, they got to have water purification, electricity grids, medical facilities, all the things that you've got to build out. So commodities we think is a good play longer term. Right now to come in at this point, because they've done so well recently, probably would be better to watch for a little correction. And don't do just oil and gas, or don't do just gold. Get an index that gives you minerals, metals, grains, livestock. They're out there, and that's the better way to do it. Private equity, real estate, we actually think has got some attraction to it. So that's where we are. So just in closing here, I think all of these are self-explanatory from the comments we made. So I'll just sort of go to the strategies and highlight what we talked about. We like financial assets. We would certainly favor stocks. We certainly feel that there's an opportunity here for participation. And then the big thing that concerns us is the second half. And I want to describe to you why that is. Right now, the economy has some pretty big props under it. A lot of monetary stimulus that the Fed's put in place, and a lot of fiscal stimulus that the government has put in place. Some of it's still unspent. You know, not a lot of that $800 billion remains to be spent, but some of it. So I want you to imagine if you have had children or if you have grandchildren and you're teaching them to walk. I can remember teaching Laura, my oldest, to walk, and I used to hold my index fingers out. She'd wrap her little prehensile hands around, and we'd take these little steps like this. And then I'd let go and see if she could walk on her own, and that's what's going to happen in the second half. We're going to find out whether this economy, when those prompts come out, assuming they do come out, when those prompts come out, can that baby, can the U.S. economy continue to grow at 3, 3.5%, 4%, or does it falter? And if it does falter, are we rushing back in there with the index fingers and pumping it back up and propping it back up until we feel more confident again and went back through the same exercise that we went through in 2009 and 2010? So that's a real concern. So investors need to be kind of wary of that and watchful of that in terms of how things unfold. If it turns out that that baby can walk on its own, the second half could be extraordinarily exciting, I believe. Okay, we've covered a ton of topics in a very short period of time. And you know, I did get a free Diet Coke, and I did get 1 or 2 pieces of the beef, and my final compensation is applause. A little bit of Q&A. I'll I'll just start with a question that somebody came up to me with I was kind of standing around back there, and they said, he looks like he's got a water. Let's ask this guy a question. And they said, Sandy, what do you think about all the deficits that are out there? The U.S. deficit, the budget debt, the accumulated deficit of the U.S., et cetera. What do you see in terms of the circumstances and the seriousness of that? And the answer is, it's damn serious. There's no way to get around it. It is very serious. There is a great book out called This Time is Different. I don't recommend it. It's not easy reading. It's about 600 pages long. The first 300 are kind of manageable, and the next 300 are impossible. But it studied the history of government defaults for several centuries. And basically, there's no magic line. There's no line in the sand that says when your deficits are this % of GDP, you go into default. Many countries have gone into default with deficit levels that are below 50% of GDP. The U.S. is about 80% deficits relative to GDP. Most of the European countries are 100 to 110% of GDP. There's no magic line. Remember, default of the government is not bankruptcy. It means I want to restructure my debt. I don't want to pay 5% for 20 years. I want to pay 3% for 40 years on the debt that I borrowed. That's what default is. So, no magic number. The problem for the United States is, and it's not a problem that I think will impact us this year or next year. Somebody might say, is it in your forecast? No, it's not. But if you ask me to make this forecast for 2015, 2016, you'd see a much different reaction if we don't do anything about these deficits. Because what happens is, the rest of the world will say, you know what, the dollar is no longer that attractive. If you want me to buy your debt, if you want me to buy your treasury bills and bonds, you're going to have to pay me higher interest. And when we start having to pay higher interest to get people to buy our debt, it's a big economic downer for the economy. And that period is maybe as close as 3 years, and certainly within 5 to 6 years, if we don't show the world that we're serious about balancing the current account situation and starting to work down the problem, particularly in the entitlement area, Social Security, and Medicare and Medicaid. If we don't get to the entitlement programs, we got a problem. A lot of people think you can just keep kicking this can down the road, and you can, and it's still available to do that, and we're still doing that. Wouldn't you love to have a politician that did the right things? Okay, but they're still doing that, but the can is gradually getting filled with cement. And eventually you're going to hit that can, and you're not going to move it. And it's not that far away. But we can still do things incrementally to show the world that we're serious. There are still things you can do with Social Security that are incremental fixes that over 10 or 15 years will send a very strong message to the markets. There are still things you can do in Medicare and Medicaid, but it's going to be painful to do them. It's not going to be fun to watch your retirement age go up, watch the indexation to inflation be changed. But those are the kinds of things that have to be considered. So that's just one question, but happy to take a few others. Yes, sir.
You mentioned $800 billion in stimulus. It seems like all the banks have paid that money back. You got government holders is giving their executives bonuses now, which Wall Street was almost thrown in jail for doing that. If that money was not spent, where do you think we'd be today?
Well, I think we'd have been. I think we'd have in the short run. I think we've been in a much deeper hole. I'd have to say that on balance, I think those decisions were the right. There was a part of my heart that said, let them fail. They got themselves into this mess. I don't want the taxpayer to bail them out. But the consequences for the average American of the slowdown in economic activity would have been far more severe, and it's been plenty severe to have a 10 or 11% unemployment rate, and that's just the published rate. It would have been far more draconian than that. And so I think in the short run, the answer is probably a good thing to have done. In the long run, we have got to quit levying public entities, non-governmental public entities, which is what a common stock is, have access to the taxpayer to bail them out. And that needs to stop. So that the risk takers know there's consequence to taking risks, that there is no safety net underneath it. And that needs to be a more pervasive part of the policy. Some of that's embodied in the new financial regulation, but in my view, probably not enough. And by the way, no matter how much you engineer regulation to solve a problem in the past, the geniuses on Wall Street will figure out a way around it for the future. Okay? Yes?
Sandy, you see mortgage rates starting to creep up in the U.S. Where do you think the LIBOR rates are going to go? Are they going to follow suit?
I couldn't hear the last part, I'm sorry.
Do you think the LIBOR rates are going to follow suit with that?
Yeah, okay. The question is, mortgage rates have started to kind of eke their way back up.